Hey everybody, this is RC Peck, and this is my weekend podcast. It is my 324th episode, and I don't have a name for this weekend, but I do have a picture for you. And the picture is this. And the theme, I guess, is really you gotta know what asset class to be in, and you gotta realize this is a really long title for this, and you have to realize that your money is always invested at all times. So if you get $100, you're fully invested with that $100 in this one asset class called currency. And if you take that $100 and you go buy real estate or gold or commodities, you're in the physical asset class. Or you could go buy some publicly traded stocks, or you could go buy some bonds. Now, each one of these asset classes has sub-asset classes, right? Large cap, mid cap, small cap, international, domestic, value, deep value, growth. There's all these different types of stocks. Same thing with bonds. You could have corporate bonds, you could have municipal bonds, you could have personal bonds, you could have government bonds. And same thing with physical. You could have commodities, or you could have precious metals, or you could have real estate. And then, of course, with currencies, you could either split it into all the different fiat currencies in the world, or you could say, no, actually, there's fiat currencies and there's hard currencies being gold and silver. But they all have subcategories. Now, here's the key. If you realize that you're always invested at all times, then you would start to think about your money differently, right? So if you had $500,000 just, quote unquote, sitting in cash, it would no longer be, quote unquote, sitting in cash. You'd be thinking of it as owning US dollars, and you'd want to pull up a price chart of US dollars, and then you could see, oh, that's actually what I own. Now, here's the thing. What determines which asset class you should be in? Now, the big box advisors and the conventional advisors, they believe you should align your money with your age and your self-described risk profile. But I think that's a mistake. I think what you should do is align your money to what the market is actually doing. Now, there's a strategy I have called LTEC, which stands for long-term economic cycles, that actually tells you which asset class or which asset classes is going to perform best over turns out to be this 18-year period, depending on what the mass psychology of people are doing. Now, I don't have time to get into the mass psychology, but basically, when hundreds of millions of people are bidding up the price of this one specific thing, there's a certain asset class you should be in. And when hundreds of millions of people are, say, bidding the price lower, there's another asset class you should be in. Now, in November of 2000, humans started saying, no, I'm going to pay less and less for that one thing that I'm leaving out in this conversation. But they decided in 2000 to start paying less and less for that. And they're still paying less and less for that today. In 2000, they were paying up to $45 for this one, let's call it this one piece of merchandise. And today they're only paying like $22 for this one piece of merchandise. And when people are paying less and less for it, there's certain asset classes you want to be in. And then when people are paying more and more for it, like from 1982 to 2000, people started with only paying $6 for this piece of merchandise. But by the time we hit the end of 99 and beginning of 2000, people were paying upwards of $45 for this piece of merchandise. Now, this matters because it determines which asset class you should be in. So when people are not wanting to pay more for this piece of merchandise, but actually pay less and less for it, it turns out there's something very specific that happens, and that's what I want to share with you in the next couple minutes. So, look at the screen here. This is the S&P 500, and it starts from 2000 and it goes till today. Now, the red line shows you where it starts back in November of 2000 till today. And during that time period, if you bought the S&P 500 and you reinvested your dividends, you'd be up 100% of your money. Now, obviously, you didn't grow on this nice, beautiful line here. You had a roller coaster ride of getting to that 100%. If you did not reinvest your dividends, you're only up 50%. So that's the S&P 500, which is representing the asset class called stocks. Now, it happens that that stocks actually are not the best asset class to be in when people are paying less and less for this piece of merchandise. What turns out to be one of the things one of the best asset classes to be in is actually long-term government bonds. Again, regardless of your age or your risk profile, you want to first align your money not with your age, but you want to align it with what's actually going on in the market. And LTEC tells us which asset classes to be in. So here are the 30-year bonds, and they are up 183% if you started buying them, or if you bought them when LTEC told you that, hey, this is the best asset class to be in. So S&P 500 up 50%. Most people don't reinvest their dividends, so that's up 50%. If you did, it's up 100. Long-term U.S. government bonds up 183%. The other asset class you want to be in when people are paying less and less for this one piece of merchandise is gold. Now, even with gold sustaining a 45% drop over 4 years from its high in September of 2011, and it dropped 1, 2, 3, 4 years, still gold is up 362% over that time period. So what I want you to take away from this conversation is it matters what those hundreds of millions of people are doing, what they're paying for this one piece of merchandise. Because there is a 300-year history. There's 300 years of statistics. There's 300 years of probability that says if you know if they're bidding that price up or down over these 18-year periods, then you know what asset class to be in. And sure, stocks went up 50 to 100%, depending on how you owned the S&P 500, if in fact you did own it. But when you compare that with what long-term government bonds did or have been doing and what gold has been doing, then you can really start to notice there's a much better way to invest your money, a way that is not aligning your money and your wealth and your future and your security with big box and independent advisors, but what's best for you. So what is the takeaway? Mass behavior matters. What hundreds of millions of people are doing matters. It matters because it determines what asset class or asset classes you should be in, or is just going to tell you with a high probability what asset classes are going to perform best over that cycle of people bidding up or bidding down that piece of merchandise. It's also going to determine how much volatility is in your investments. Even with the long-term government bonds, if you remember that image in your brain, the worst fall you ever would have had so far is about a 19.5% fall. Comparing that to the S&P 500, where you would have had your worst fall would have been a 58% fall. Bonds went up, including dividends, 183%, worst fall being 19%, and stocks went up 50 to 100%, depending on how you invested in them. And you would have had to have sustained two 50% falls. And then gold having gone up 360%, even with a 45% correction. It also determines how much security and freedom you have. So knowing this mass behavior matters. Now, what that actual piece of merchandise is outside of this conversation. What I wanted to do and what I wanted to point out to you specifically is there are better ways to grow your money than just aligning your money with the big box advisor business model and the independent advisor business model. And I will also say this, doing it yourself with pick of the month newsletters can be very, very expensive. And the reason is because you are exposed to your lesser self a lot. And your lesser self is going to do horrible things to your money. There is a very long history of that happening. Thank you guys. This is just another step in helping you protect your portfolio and protect your future. Until next time, this is RC Peck.